All right, we start out little change and then we move. Yesterday, it was to the downside. Last week, to the upside. We have 30 minutes to see what happens today. I'm Matt Miller.
And I'm Katie Greifeld. Sonali Basak on assignment today, and Bloomberg Open Interest starts right now.
Coming up, stocks stall. Caution mounts as investors look ahead to tomorrow's inflation report for more Fed clues. And Oracle's cloud growth also failed to impress. While TSMC's November sales jump on strong demand for AI, no surprise there. Citi's critical year after major changes at the bank. CEO Jane Fraser tells Sonali Basak the payoff is coming, but shareholders are still waiting. Let's take a look at where markets are trading this morning. As I said, we've seen very little movement at the start, and then we get running throughout the day. Today is no different. S&P futures absolutely unchanged right now. NASDAQ futures up about 0.1%. The U.S. 10-year yield also not moving much, although we're creeping up a little bit higher. Yesterday at this time we were 417.
That's true.
Now 422.
We are 5 entire basis points higher than where we were 24 hours ago, which honestly isn't saying much. But let's take a look at some single stocks here, because you have Oracle falling from a record high after its latest results dented enthusiasm about the company's cloud business. Shares off about 7%. But take a look at Designer Brands sliding in a big way after the parent company of DWS cut its adjusted EPS guidance for the full year. Shares down almost 22% pre-market. And I wanted to end with Toll Brothers here. Also lower. That's after the home builder's profit margin projection fell short of estimates, down about 4% right now. So that's the micro. Let's talk about the macro. We got some interesting data, of course, when it comes to small business optimism this morning at 7 a.m. And unsurprisingly, Matt, if you take a look at the cohort of small business owners in America, their optimism surged in November.
Yeah, absolutely. I mean, the biggest jump that we've seen, I think, on record, in terms of the index, up 8 points. That's fairly meaningless unless you work with the index on a regular basis.
But it's a lot.
But it's to the highest level since 2021. By the way, remember when we got the Michigan sentiment numbers last week? You can also break the sentiment numbers up by what Republicans expect and what Democrats expect. And if you look at that chart, I mean, the red line representing Republicans taking off there. And of course, small business owners are very Republican. They lean heavily R, right?
I think that's a fair statement to make. What's interesting, though, if you take a look at the details of this small business survey, if you take a look at future plans, a net 28% said that they plan to raise prices for the next 3 months. When it comes to the labor market, 18% of owners expected to create jobs, new jobs, in the next 3 months. So we're talking about a short-term horizon here. Peter Bukvar had a really interesting note out this morning in reaction, asking how the Fed can cut interest rates next week in the face of this burst of economic optimism, even whether or not that's realized. Just the fact that you do have all of this planned activity certainly tells you something.
Yeah, I mean, they're still going to do it, right?
Yeah.
They're going to figure out a way to cut rates.
They're going to look through it.
Unless they telegraph to markets that they won't. But I think the inflation point is really interesting because Bill Dunkelberg, who runs the NFIB, had a quote in our story saying something along the lines of, oh, here, we actually have it here. Wow. Owners are particularly hopeful for tax and regulation policies that favor strong economic growth, as well as relief from inflationary pressures. And I think it's the third point that could be a problem for these business owners going into 25 and 26.
Yeah, I think that's a cake, a having it situation, and also eating it as well, which for some reason is hard to do.
Let's talk right now to Saira Malik. She joins us from Nuveen, where she is head of equities and fixed income, as well as the CIO at that shop. Saira, great to have you on the program. Thanks for joining us this morning.
Nice to see you.
We hit, I think, almost 6,100 on the S&P Friday. 6,099 was the session high. And since then, you know, I guess investors are maybe taking profits ahead of this inflation print. But what's your take on the inflation situation and the Fed setup for December 18th?
Well, momentum stocks, which have been a huge driver of this market, had their worst day in almost 2 years yesterday. And that was for 3 reasons: China, CPI, and market valuations. So starting with China, you know, there was also some moves around potential policy easing, but even more importantly for momentum stocks, potential regulations on NVIDIA, which is a negative for tech stocks. overall. Valuations for the markets currently trading at about 22.5 times 2025 earnings. I think people are concerned that's a little over 4 ticks higher than the historical median. So markets are expensive at this point. Where do we go from here? And then, of course, CPI, it's going to come in a little over 2.5% year over year tomorrow on the print, up about 0.2 to 0.3%. It's going to show us that that last mile of inflation is going to be a tough battle for the Fed. Now, I don't think this changes much the odds. There's an 89% chance, according to the markets, the Fed cuts rates on December 18th by 25 basis points. I think that one's intact, but 2025 looks a little bit more murkier in terms of rate cuts, inflation, and the outlook.
Yeah, it's pretty much a lock. I think it's safe to say that next week the Fed is going to cut rates. But you think about 2025, their plans there, like you say, it's murky. And when we think about what the driver is going to be in 2025, is it monetary policy, is it the Fed, or is it fiscal policy?
I think we're looking at inflation, the Fed, and also the new administration. So inflation, that last mile, could some of the new administration's policies reaccelerate inflation? And if that happens, what does that mean for the Fed? I don't think we're going to get 25 basis points rate cuts every time the Fed meets in 25. And I'm doubtful we'll get something like a 50 basis point cut like we saw in September. So more caution from the Fed next year. And that's because looking at the new administration, taxes, tariffs, and regulations are going to be important. Tax cuts, that's a pro-growth for the U.S. economy, for consumers and corporates. Regulations, we expect deregulation. That could help open up the M&A market. Also, I think more of a pro-growth stance there. Tariffs a bit more mixed. We've already seen some talk about tariffs, 25%, 10% tariffs going out against Canada, Mexico, and China. It's difficult to say exactly what that will do to U.S. growth, but all of this together could mean that inflation reaccelerates. And if that happens, that's going to tie the Fed's hands a little bit.
Yeah, I mean, it seems difficult. I think of, the automakers there that I focus on. If you start raising tariffs on goods from Mexico and Canada, that's a real problem for them and many of the industrials in this country. And then the one that we never talk about is the mass deportations. I know some people think it was just a campaign slogan, but those were the main signs at the RNC. That's like their main populist push, is getting rid of 15 million workers from this economy. Is that not a huge concern?
I think we need to look at that in terms of one of the big drivers for this market, which has been payrolls and employment. We just saw last Friday's payroll numbers come in very strong on a rebound from strikes and storms and the weaker number in the prior month. But with deportations, what does that mean for the employment markets? What does that mean for wage inflation? If that starts to slow down the employment markets even more so, and we have seen that already in the last 12 months, payrolls growth has slowed by about 50,000 overall. We're currently running at a rate of about 150 payrolls produced per month on average over the last few months. If that slows more because of deportations or wage inflation picks up as who's taking the job switches around, I think that could be an issue for U.S. growth, because two drivers for economic growth have really been consumer spending, and we'll probably see a lot of that this holiday season, and also employment growth. But I will say one thing. I talked about how yesterday was one of the worst days for momentum stocks over the past 2 years. Normally, when we've seen that, momentum stocks have actually worked quite well from there. So history does support that this would be a buying opportunity for momentum stocks, not a time to pull back.
I want to talk a little bit about small caps, because in this conversation about tariffs, for example, is one of the things to keep an eye on next year. You make the point in your notes that in some sense, it's actually tariffs might benefit the small caps. Talk us through that argument.
Sure. So small caps, they've been cheap versus large cap for a very long time. So there's this argument, okay, they're trading at, you pick your number of decades, 2-decade lows versus large caps. And does that mean it's a buying opportunity? I always say you need to find a catalyst. Otherwise, a sector or a stock can stay cheap for a long time. So looking at taxes, tariffs, and regulations, and in terms of how does that impact small caps? So first of all, tax cuts positive overall for the U.S. economy. Smaller companies more leverage to the U.S., so that's a positive there. Tariffs, more focus on the U.S. Small caps tend to be more domestically oriented than large caps, which can be more multinationally oriented. So that's another positive for small caps. And then deregulation could open up the M&A market more so, and that could lead to more M&A from large companies buying small companies. So I think those are the three catalysts for small caps, which are already cheap.
Is there a specific industry that you like going into 2025, Sarah? I mean, I know we talk about AI all the time and so much CapEx going into the infrastructure setup over the next few years. Is that your main focus? Is there something that we're missing?
Well, infrastructure is a sector on the public and the private side that we like a lot for many reasons. First of all, the build out of AI and data centers. Second of all, more focus on energy with the new administration, more build around that. As we move to even renewable energy, upgrades of the grids and electrification of our grids are going to be positive for infrastructure. We are more concerned about the consumer next year. Consumer stocks overall had a very strong year, as the markets did, but I think consumer spending could start to peter out. We are concerned about that next year. But infrastructure, I think, can be a strong multi-year play for the markets. And I wouldn't count out technology stocks. Artificial intelligence is here to stay. That build out will continue. You just need to be more selective when it comes to tech stocks going forward.
When does AI start to benefit all sectors? Because I'm thinking, of course, about Oppenheimer's call yesterday. They raised their price target for the S&P 500 to 7,100. And part of the reason why is because they think that companies in all 11 sectors could benefit from improved productivity via AI to further serve the needs of businesses. And it goes on there. But do you think that that is a story that plays out next year? Or what kind of timelines are you thinking about when it comes to AI?
Well, the holy grail for AI is the monetization of AI across multiple sectors. But how is it going to play out? Well, first of all, artificial intelligence operates off tons of data. So we look at those sectors that have a lot of data and history, healthcare, where there's a lot of R&D data that AI can become much more efficient of going through. Financial services, a lot of trading data, all kinds of data in terms of the history of how we manage money on the asset management side. And interesting, I think AI will be something that proliferates over there over time. So I think there'll be certain sectors where we see it more faster than we do in other sectors. But part of the reason why since July of this year, AI stocks took a bit of a pause is because companies are waiting now. We've spent billions, tens of billions on AI, companies across the board have. And now we need to see where's the monetization there for companies? How is that going to improve our productivity and our margins? I think that's the wait and see. I don't know if 2025 will be the year where we see it across the board, but I think over a number of years, you will see it impact multiple industries to the positive.
All right, Saira, great to catch up with you. Appreciate you taking the time this morning. That is Saira Malik of Nuveen. Meanwhile, let's get a check on futures right now. As Matt Miller said, pretty much unchanged, but we do have a little bit of movement to the upside. The S&P 500, the color is green at least. That follows a wipeout yesterday. The tech index, the NASDAQ 100 there, a little bit higher, up 0.2%. The Russell 2000 just about flat, but we know there's more movement going on under the hood. Let's get to Abigail Doolittle.
There certainly is, Katie, beneath that relatively or actually very benign surface. Let's take a look at some of the stocks that are moving quite a bit, including the shares of Alphabet right now, up 4.5% at pre-market session highs. This as they recently discussed their breakthrough in quantum computing. They've announced their Willow quantum chip is really doing quite well. Mizuho says that's why the stock is up so much this morning and clearly outperforming the S&P 500 and the NASDAQ 100. As for MongoDB, not so much. The database software company, the shares are down quite significantly, down the better part of 8%. They actually put up a great quarter, beating and boosting. However, their old CFO, Michael Gordon, he is departing, or maybe he's still the current CFO, but he's on his way out. And Guggenheim is saying that's outweighing the positives, and that's why the stock is down. And then finally, turning to the shares of Boeing, well, we have a rare green day here. This stock down more than 40% on the year today, up almost 2%. Reuters is saying that last week they restarted their production of that 737 MAX about a month after the end of the strike. So there is some hope. Investors clinging to it, Matt.
We love a green day, right? Are you a fan, Abigail?
A Boeing?
Green Day.
Green Day, the band. I'm not so familiar with them, but the one or two songs I know, yes, very positive.
I've been thinking recently that I think Green Day may have a better overall catalog than Bad Religion in terms of sort of post punk pop.
Yeah. You know what I was thinking of yesterday? You know how Taylor Swift, the Eras Tour, is ending? It's such a great concept. A band like Green Day that has the discography to back it up, they should do an Eras Tour.
Yeah. I would go.
Yeah.
For sure. To that. By the way, tickets go on sale today for the next Dead & Company tour of the Sphere.
Wow.
Starting in March. So I guess it's the pre-sale. Mike McKee told me he's already in on that.
I'm sure.
Back to the markets. There are storm clouds gathering around Oracle this morning. Even though the earnings were pretty much in line with expectations, we'll take a look at the company's near misses in the second quarter and with their third quarter forecast. Next, this is Bloomberg. Let's get now to high interest and look at what's making headlines around the world. Israel is stepping up its attacks on military sites in Syria, striking hundreds of targets across the country. The Israeli attacks have drawn criticism from Arab countries, including Egypt and Saudi Arabia, which accuse Israel of seeking to occupy more Syrian territory and sabotage the country's security and stability. Brazil's President Lula da Silva is awake and conscious after undergoing emergency brain surgery in Sao Paulo. His doctors say he will stay in intensive care for 48 hours as a precaution. Lula was suffering from headaches late yesterday. A brain scan showed a rare bleed resulting from an accident he suffered, a fall that he suffered at home in October. And authorities in New York filed murder charges against a 26-year-old man accused of shooting United Healthcare CEO Brian Thompson last week in Midtown Manhattan. Luigi Mangione was arrested after being spotted at a McDonald's in Altoona, Pennsylvania, where he was found with several fake IDs, a ghost gun and a silencer, and a 3-page manifesto. The suspect's social media reveals he read and admired the writings of Ted Kaczynski, the Unabomber, also a fellow Ivy League graduate and considered a domestic terrorist. Katie?
Well, switching back to the stock market, one stock we're keeping an eye on this morning is Oracle, dropping in pre-market trading. That's after earnings failed to impress bulls who boosted the stock to a record high on enthusiasm for its cloud business. Anurag Rana, Bloomberg Intelligence senior tech analyst, he joins us now. And just for context, Anurag, we're talking about a 52% increase in sales from the cloud infrastructure business. So it really feels like we're talking about a case of high expectations here.
Yeah, in fact, they beat those consensus numbers in that as well. And typically what we see in momentum stocks, or when you're looking at a particular theme and people riding that wave, that if the beat is not strong enough, people are disappointed. And I think clearly that's the case here. The backlog is very good. There could be some supply challenges about fulfilling demand, but overall, I think a very good quarter for Oracle.
So why does the market find this so disappointing? I'm looking at the shares pre-market down 7.33%, Anurag. That does not reflect a good quarter in my experience.
Yeah, I think, one of the things is the stock's done really well over the last 12 months or so. And as I said, clearly 52% was 1 percentage point above what the consensus was, but it seems that the buy-side expectations were probably higher than that. Now, the second half of their fiscal year, this cloud infrastructure business is going to accelerate from here. The question is going to be how much acceleration, and I think there is some question about whether it's going to be in the low 50s or the high 50s. So to be very honest here, we are just splitting hairs.
And so, I want to talk about the competitive landscape a little bit here, because Oracle is a big company. If you take a look at the market cap, over $500 billion. But you think about its competitors in the cloud space, Amazon, Microsoft, in the trillions. So just give us a lay of the land when it comes to Oracle trying to compete with these absolute giants.
So when you look at the cloud infrastructure space, it's dominated by Amazon Web Services. After that, it's Microsoft Azure, then Google, and now I would say that's Oracle after that. What's happening is because of increased interest in enterprise AI, companies are coming to cloud providers and saying, let's host our applications, other things that we're going to experiment on in one of these cloud platforms. So all of them are seeing an increased interest from customers. To Oracle's advantage, it's actually getting work from Microsoft right now. It has a partnership with Microsoft. It recently signed a partnership with both Google and Amazon. So I think from their side, they have the money to spend to increase their data center capacity, and people are coming to them because of that.
I want to ask you, Anurag, about a stock that Mandeep Singh actually covers, but you're both senior technology analysts. Google has revealed a quantum computing setup that has solved a problem in 5 minutes that would take, it says, any other supercomputer 10 septillion years. That's 10 to the power of 24. How significant is this?
So when you look at any of these large tech companies, in fact, Google has been under a cloud because of the attack on its search business for a lot of these OpenAI kind of tools. What you see here is the pace of innovation. You people really should not think that Google is behind in any of these initiatives, whether it's chip, whether it's search, whether it's any of the AI initiatives. And I think that's what's being received well by the market today.
All right, Anurag, really appreciate your perspective there. That is Anurag Rana of Bloomberg Intelligence. Now, still ahead, we'll be joined by Newedge Wealth CIO Cameron Dawson, weighing in on the tech trade as we head into 2025. She says markets are wrestling with stretched valuations and growth expectations. This is Bloomberg. All right, welcome back to Open Interest. A check on futures with minutes to go until the bells ring. You can see a little bit of action to the upside, and I stress a little bit on the S&P 500, higher by about 0.1%. A little bit more movement if you take a look at the NASDAQ 100, up about 0.2%. We know we had an ugly start to the week, of course. We had a big decline in NVIDIA, about 2.6%, of course, after China accused it of some anti-monopoly behavior with the 2020 acquisition of Mellanox technology. That weighed on the index overall, and we'll see, of course, if we can turn it around. We have CPI tomorrow. That could be a catalyst, and then I think we have a Fed meeting next week. But in terms of now and year end, we're running out of stuff to talk about.
Well, I was thinking of coffee.
Yeah, tell me.
So maybe we've seen a huge jump in prices for Arabica, the Arabica bean, which is, I'm sure, the one that you prefer, up 80% year to date. And maybe it's what's led to the malaise in the past couple of trading days. This also could have an impact on the inflation numbers that we see on Wednesday.
That's true. It's harder to source your caffeine. You're going to have to pay up for that. And it does have economic impacts, as you mentioned. Anyway, 4 minutes to go until the opening bell. Cameron Dawson joins us to take you through the action. This is Bloomberg.
We are moments away from the start of trading. This is Bloomberg Open Interest. I'm Matt Miller. We don't see a lot of action in futures right now, but the color is green. So S&P futures, even with the disappointment of Oracle to the upside, about 0.1%. NASDAQ futures, tech stocks doing even better, 0.2%. We don't see that rotation today, at least not yet. A lot could change. You hear the opening bell down on the floor of the NASDAQ market site. You've got Transmedics. That stock, even though it's down 50% in the last 6 months, has quadrupled in the last 5 years. Then the New York Stock Exchange, I believe you have Alaska Airlines also out with a positive outlook today, as many airlines have been. And I think this is also very fascinating because my former co-host on Bloomberg Radio, Paul Sweeney, he always thought that the man on the tail fin of an Alaska Airlines plane was actually Jerry Garcia. And it's clearly not, although, you know, I could see why he made that mistake. It's an Inuit man from Alaska, not the late lead singer of the Grateful Dead.
I'm glad we've put together that package to really illustrate what you're talking about. Sort of.
You can see it, right?
I can kind of see it. I mean, maybe I'm biased because we're showing that photo and then going to the other one. In any case, we are just seconds into the trade. Let's talk about these markets right now. Now, not a lot of clapping and cheering, like Matt said. It's a pretty quiet start, but as we have been watching over the past couple of weeks, a quiet start and then a lot of action by 4 p.m. Where we stand right now, the colors are green, a little bit of a lift, relatively speaking, to the NASDAQ 100 after that nosedive we took yesterday. The Russell 2000 also falling in a big way yesterday, continuing that momentum to the downside today. The Russell 2000, those small caps off about 0.2%. Let's look under the hood right now. Let's talk about designer brands, lower right now after the parent company of DSW cut its adjusted earnings per share guidance for the full year. You can see shares off by about 14% right now. We had been lower by more than 20% pre-market, so some of those losses coming back. We also want to talk about MongoDB here. It's falling after the database software company announced the departure of its CFO and COO, Michael Gordon. It also reported earnings yesterday. You add it all together, shares are off about 10%, Matt.
All right, Oracle is down from a record high. The software maker's cloud business failing to live up to the raised expectations. I mean, it seems like everything that Oracle put out was just a step behind, right? If we were looking for $1.57, they put out $1.56 in terms of the earnings reported and the forecast for the third quarter. Let's take a closer look with Bloomberg's Abigail Doolittle. Abby?
Yeah, well, price to perfection is one way to put it. Oracle into today up about 80%. Today falling down about 8.4%. Small misses for both top and bottom line, but it's the outlook that's just a little bit light. And then we have C3 AI. They put up a great quarter, beating all of the different metrics, but it just came out recently that their CEO, Thomas Siebel, well, he plans to sell stock. And we're taking a look at that one to put all of this in perspective. As for that Oracle decline, the big piece that's really dragging on this stock is the future outlook. If we take a look at what's happening for sales, we are going to see in the quarter that just was very nice sequential growth above where we had been in the first quarter of fiscal year 24. But for the quarter that we're in now, the sales growth is expected to fall to about 8%. And for a company that puts up so many billions of dollars in revenue, that's a pretty decent chunk in a sequential basis. The cloud basically just in line. So again, price to perfection. And let's take a look at that with also C3 AI, the SOX, and the S&P 500. There's Oracle. It had been up about 80% into today, now taking a nosedive. The same deal for C3 AI, which into today had been up 45%, also sharply higher. And there's the S&P 500 going along steady, up 29%, a very healthy year so far, Katie, and we're pretty close to the end. And then the SOX, it's just really interesting to note that the SOX is lagging all, but still up 20% on the year.
All right, great context there, Abigail. Appreciate that. Is Abigail Doolittle. And let's keep this conversation going now with Cameron Dawson. She is Chief Investment Officer over at Newedge Wealth, joining us on set. Cameron, it's great to see you.
Good to see you.
Let's talk about inflation. Of course, we have CPI coming up tomorrow, one of the last big data releases of 2024. And we had the Small Business Optimism Index out from the NFIB. And the details of the report were so interesting. A net 28% said they plan to raise prices over the next 3 months. A net 18% of owners expect to create new jobs just in the next 3 months. It seems like price pressures could be coming back if you take all of that holistically.
Certainly, that we think that inflation has this lingering stickiness to it. It's not necessarily that it has to reaccelerate in a way that we retest the highs that we got to back in 2021, but we certainly still see signs that you could have inflation just linger around. And so as we're looking at the risks into 2025, I think the one thing we have to be very aware of is also energy prices. They have been down on a year-over-year basis consistently for the last 2 years. If that does not persist, that headline inflation number could actually start to tick a little bit higher simply because we're losing the benefit of falling gas prices.
I mean, it's so funny. From the NFIB owners are clearly wish casting here, right? If you take a look at chart 2309 on the Bloomberg, they say they're going to raise their selling prices at their businesses, raise prices and raise wages, and yet they expect inflation to come down. Yeah. Like, in what world are they living here?
Well, we do know that NFIB is particularly sensitive to the political outcomes. We saw a big surge in it after 2016 as well. And so we have to take some of this with a grain of salt, that soft data doesn't necessarily translate into real hard data.
Right.
But one of the things that we've been seeing that's been a trend for the last year is that companies have been saying that they have falling pricing power. Consumers are pushing back on price increases. So wish casting very much so that they think that they can continue to raise prices, mostly because the consumer doesn't have that much wiggle room to absorb higher prices.
Does it matter, though, to the market, Cameron, if we get a little inflation? Didn't Trump on the Sunday shows say
he can't guarantee that tariffs won't cause inflation?
Yeah. But how much does it matter if we get inflation back up to, say, like 4% in 2025?
Well, it certainly would raise the prospect of a return to rate hikes and not rate cuts. 4% inflation, I think, would be very, very startling for the bond market, and thus would be startling for the equity market trading at 22.5 times earnings. This equity market really does not have any wiggle room to absorb much higher bond yields, mostly if we press up back to that 5% level. So if we get to 4%, And we don't necessarily think that that's our base case at this point. But if we get to 4%, that would certainly roil markets.
Well, what is the base case from where you sit when it comes to inflation, what the Fed does to handle it? How does that inform your game plan headed into 2025, coming off of 2 straight years of back-to-back 20% plus gains?
The base case on inflation is that it's not going to be hot enough to justify further hikes, but it's also not going to be cool enough to justify deep further cuts, meaning that we think that the Fed goes in December, but maybe just goes 2 times, assuming stable kind of growth in 25, meaning that in order for the Fed to deliver more than 2 cuts next year, you'd have to see growth fall off a cliff. And that then raises the question of how that translates to equity markets. Equity markets are expecting 13% earnings growth next year. So that certainly isn't an environment that suggests that growth falls off a cliff.
Is that wish casting, that kind of earnings growth?
We think the margin number is wish casting. You have margins set to go to a new record high, all with revenue growth staying in the 4 to 5% range. The interesting thing is that inflation drives higher revenues growth, which drives higher margins. So you actually could see margins be attainable if you get that higher inflation number, because it would drive an acceleration in revenue growth.
Cameron, people always talk about cash on the sidelines, and we show the money market funds rising up to $7 trillion, but it doesn't seem like that money really drives prices higher. And Cole Smead was on with us yesterday. Yeah. He argues that U.S. households are fully invested. Yep. Institutions are fully invested in stocks. Even international investors are fully invested in U.S. stocks. Where is there extra money to drive this index, the S&P higher from 6,100?
We think that's the biggest question into 25. We think there's a little bit more room for institutions to get fully invested. Look at the Deutsche Bank Consolidated Positioning Report. It's at about the 85th percentile, so that has a tiny bit of room. But look at Fed surveys, look at the AAII. Those both show households near 20-year highs in allocations. And the incremental dollar flow is coming from leverage. FINRA margin loan balances are up 45% this year. You also see people taking on leverage through leveraged ETFs, through option volumes. So people are pushing all of their chips into this equity market at the same time that earnings expectations are high, valuations are high, sentiment is stretched. That creates an incredibly high bar into 25. Doesn't necessarily mean it's the top, but certainly we think that it's a very extended bar to jump over.
Yeah, and it's certainly a pressing question. Who is the incremental buyer left in this market? I do want to talk about the rotation trade. It was so in vogue over the summer. We talk about small caps all the time on this program. We talk about the sectors, those underloved sectors that might be still getting a second look. Does that continue in 25?
That is the ultimate question. We do think that growth versus value might be the most important chart to watch for 2025, because that encapsulates all of this idea about the Mag 7, which is 55% of the growth index, and whether or not that leadership can persist. One of the things we have to be aware of is Mag 7 earnings are set to decelerate significantly next year, from 55% this year to 20% next year. So can you continue to see the kind of leadership with that second derivative slowdown? It's a big question, because value has also consistently disappointed on the earnings front.
Broken a lot of hearts.
And same with small caps. Russell 2000 earnings estimates are down 30% this year for 2024.
Ouch. And they already lose money, most of them, right?
40% are losing money in an economy that's growing above trend. So you have to see lower yields, much lower yields, for some of that to turn around. So we do think that the small cap chart from a technical basis looks really attractive. From the fundamentals, it does give you a bit of pause.
All right, Cameron, you're an absolute wealth of information. You're like an AI, so I'm really glad that you could join us this morning. Cameron Dawson there of Newedge Wealth. Coming up, President-elect Trump's win is adding fuel to the outlook for General Motors. Top calls are next. This is Bloomberg.
Welcome back to Bloomberg Open Interest. Let's take a check on stocks. We're about 15 minutes into the session, and we do have some developments underway. Don't look at the S&P 500. Not much is going on there. The NASDAQ 100, though, is making a run for it. Now up about 0.5%. We think about those losses that we saw yesterday on the heels of NVIDIA falling. Not today. A turnaround underway when it comes to big tech. I can't say the same about the small caps. The Russell 2000 down about 0.5% right now. This has been your leader for months now, but taking a bit of a breather on that rotation trade. Let's also pull up the VIX and take a look at the VIX. We've been talking about this fully allocated market, all of this exuberance, and I feel like the VIX really tells this story because we are at very low levels relative to history, even relative to the past 1 year. Remember, we had that spike up in the summer. That feels like a long time ago because right now trading with a 14 handle, not quite at the lows of this year, but who knows, a lot can happen. Meanwhile, it's time now for top calls. Some of the analyst action in focus this morning. And first up, Morgan Stanley upgrading General Motors, saying the automaker is no longer a sell. The analyst notes that investors have been bidding up combustion engines related names since Trump won the U.S. election, but Tesla was also reiterated as a top pick, so a lot of cross currents there. Next up, we have Jefferies cutting eBay to a sell. The firm sees sluggish profit growth thanks to a decline in ad revenue and increased marketing costs. The analyst also says that the slowdown in China increases growth risks for this e-commerce company. Shares down almost 4%. And finally, we have Bernstein upgrading American Air to a buy. The analyst highlights a positive industry backdrop thanks to lower fuel costs and says that the carrier's co-branded credit card deal with Citi enhances Americans' outlook. Interesting stuff there. Shares up about 4%. Now coming up, Citi CEO Jane Fraser is halfway through her 5-year plan to turn around the bank. We'll take stock of her progress in today's Wall Street Beat. And also happening right now, Bloomberg's inaugural Women, Money and Power event underway in London. You're looking live at a panel with top executives from UBS, HSBC, and Goldman Sachs discussing what to expect next in global M&A. You can watch the full conversation on your terminal at LiveGo or follow our blog coverage at TLiveGo on your Bloomberg terminal. This is Bloomberg.
Not sit back and rest on our laurels. We have to continue to push forward. I'm concerned now with a new president coming in that the Title IX program doesn't get stymied.
Citi CEO Jane Fraser previously said she needed 5 years to pull off Wall Street's most elusive turnaround. Now, well over halfway through that period, she says she's committed to her goals. Fraser spoke exclusively to Sonali Basak.
My ambition is to be a high-returning, high-quality earnings, modern, simpler institution that continues to play a shaping role in the global financial system. We're truly privileged to be in as many locations as we are, with a talent base with such a global mindset and an ambition about it. So I think about we've got the right strategy and vision, we're executing with the right organization, we've got making sure we've got the right talent and culture in the firm, and that we're a simpler, well-controlled, modern organization. We'll have got the job done.
If you could give yourself a grade on the restructuring plan, what would you give yourself?
Oh, we aren't done yet, so I can't give ourselves a grade yet. I've always said that this is a multi-year journey. We're going to be very disciplined about making sure that we don't take shortcuts. And the problem with grading yourself along the way is it becomes too tempting to do a quarter-by-quarter grade, as opposed to we're just very, very focused and accountable for delivering what the end product looks like.
Speaking of the end product, you've set out a goal to bring returns on tangible common equity closer to 11 to 12%.
In the medium term and beyond after.
So Bloomberg consensus this year has Citigroup's return on tangible common equity at 6.8%. What do you say to critics that feel like you're not getting there fast enough?
We have undertaken a multi-year major transformation of an institution. We are working with ambition, with accountability, and with urgency. So we've already divested all but one of our international consumer franchises and wound down those that we couldn't. We've undertaken a massive reorganization of a company of 240,000 employees in 6 months. such that 50,000 people have a different manager than had 6 months ago. Now, it's been major change. We're being bold. We're ambitious. We're holding ourselves very much to account to deliver on the outcomes we should do. And I say, look at the proof. We're delivering, and we're determined to keep on doing so.
All right, let's take a deeper dive into Jane Fraser's turnaround because it's the subject of today's Big Takes. Bloomberg's Todd Gillespie joins us now with more. It's a great story, and you take a look at the chart of Citigroup since Jane Fraser took over on March 1st, 2021. Shares are up 21%. You compare that, of course, to the financial sector, which is up about 60% in that time. That seems to be a report card of sorts.
Certainly a report card of sorts, Katie. And I mean, what she's had to do once she got in is implement this big turnaround plan. She's kind of asking people to really sit with her. She has done for years now to do, investments behind the scenes in data controls. She's streamlined the bank. She's really kind of had to overhaul, this laggard bank, basically, that's never really recovered since the financial crisis, let's be honest. It was once the largest financial company in the world, the largest bank in the US, and now it's really trailing peers. She's asking us to, keep the faith. She's asking people to, look at her proof points, look at the returns that are coming next year. But some people are obviously getting very impatient.
Yeah, I mean, it makes sense because if you put her in place in March of 2021, that's almost 4 years ago. As you said, she's made huge sweeping changes, and yet her stock lags Goldman Sachs, it lags Morgan Stanley, it lags JP Morgan, it lags Bank of America, it lags Wells Fargo. I mean,
yeah.
I understand that they were in a bad position, but 4 years is longer than Pat Gelsinger had. Like, she's got to turn this ship around at some point.
Yeah, I mean, she set out her very clear return on tangible common equity goals in March 2022 on Investor Day that year. She says that by the end of 2026, she can start really competing, with the bigger guns in this sector. She says that she can get to an ROTCE of 11 to 12%. They're sitting rather unpretty, just under 7% is the outlook for this year right now. We're looking at Wells Fargo at 13%, Morgan Stanley over 17%.
Here's a chart from her start. So from March 1st, 2021, Citigroup in white, everybody else you can see is
totally.
ahead.
And she's got a board meeting this week. Citigroup's board is meeting. She's on there. There are definitely going to be questions that she's going to need to answer, this week, today, tomorrow. And certainly that chart is certainly going to be on the wall somewhere.
Well, Blair Efron, who you quote, does make the point that she's turning around a super tanker. She's had several years to do it, but we are talking about a super tanker. But let's talk about how high the stakes are. I love this quote that you have, of course, from sell-side analysts. I think it's Mike Mayo saying that he's doubling down. So he's bullish, but if I am wrong, there's a point where Jane Fraser is no longer CEO in the next 18 months. Are people having those conversations, and does 18 months sound realistic?
I'm not sure they're having those conversations just quite yet. I mean, the idea is that those proof points need to start coming through in the numbers in the next 12 months, realistically. What she said this year and what she said since the beginning of her strategy, to be fair to her, is that what Citi needs to do is post consistent gains, post consistently, show that they can set guidance and meet it. Mark Mason this morning, the CFO, just spoke at the Goldman Sachs conference and actually reiterated guidance for the year, said that revenue will come in the high end of that guidance, which, so far it was perhaps a low bar compared to other banks, but they are maybe starting to show that they can start to deliver. We're going to have to be looking very closely at those returns numbers next year, quarter by quarter, and make sure that those are consistent and that there are also no other regulatory hiccups like Citi is, very well known for.
18 months is more than 5 years. That's a generous chunk. And Mike Mayo, I wonder if you'd agree, is one of the least BS analysts on Wall Street, right? He says what he means.
Yeah, I mean, Mike Mayo was very focused on this, the strengths that he sees coming through from this reorganization, this simplification. Yep. He's done a lot of notes sort of showing how that breakdown and that streamlining should improve operational efficiency. So we'll see if that, proves true in the numbers.
Todd, great big take. Recommend people check it out on Bloomberg.com. Search for Todd Gillespie and Citigroup. Coming up, we're going to talk to Larry Adam from Raymond James and Barry Knapp from Ironsides Macroeconomics. This is Bloomberg. We are 30 minutes into the trading day. Welcome to Bloomberg Open Interest. I'm Matt Miller.
And I'm Katie Greifeld and Sonali Basak on assignment. And coming up, caution mounts as investors look ahead to tomorrow's inflation report for more Fed clues. A handful of powerful Republicans may determine whether President-elect Donald Trump gets the cabinet he wants. We'll head to Washington for the latest. And targeting a trifecta, market strategist Barry Knapp outlines the fiscal, regulatory, and policy changes facing investors in Trump's second term. All of that and more coming up. Let's get a check on these markets. I'm going to try to sell this, Matt. You take a look at the S&P 500 right now, up about 0.1%.
Wait, I thought caution was mounting.
Caution is mounting.
It's mounted.
You're not necessarily seeing it right now in the S&P 500, but we had a pretty ugly day yesterday, so rebounding a little bit here. Same story in big tech. The Nasdaq 100 up about 0.3%. Of course, we've had a wipeout yesterday with Nvidia down, but a little bit of green on the screen today. And then the bond market crickets right now. Yields higher by less than 2 basis points on your 10-year Treasury yield. We've been oscillating around these levels, it feels like, for a while right now. Yeah. Ian Lingen pointing out in his morning note that we're trading around the 200-day moving average for the 10-year Treasury yield, and it certainly feels like we can't break out of it.
Right. Well, we were just talking to Cameron Dawson, and she says this is kind of the upper limit. If it goes higher, it's difficult for the stock market.
Yeah.
By the way, you know what's a fantastic program that I listened to on the way home?
I was hoping you'd tell me.
From work yesterday, Bloomberg Business Week on Bloomberg Radio is a really great way to get home.
Yesterday was particularly good. I was filling in. Tim Stanovic was also
Are you doing
there.
it again today?
No, thank goodness. I'm going home.
All right. Let's talk about these markets here because it does seem like, we're bumping up against a top. Larry Adam joins us, Raymond James, Chief Investment Officer. And Larry, on Friday, we hit almost 6,100, 6,099 on the S&P. And it feels like there's just not a lot of investors out there who haven't yet fully allocated to stocks, right? What else pushes us higher?
Well, I'm more cautious here in the near term. I think one of the things that you're mentioning is this complacency that continues to unfold. And there's a survey, the Consumer Confidence Survey comes out and asks investors, do you think the equity markets are going to go up over the next 12 months? And in the most recent survey, 54% of those surveyed said that the market was going to go higher. The significance of that is that that's an all-time record high. And historically, when that's gone above 45%, the market 1 year later has been up on average only about 1%. So I think we just need a little digestion period here. I mean, we've had a monster rally in this equity market, particularly given this was an election year. So I just think we need, a little bit of time just to let it cool off and digest and then move higher, next year.
Great perspective. I mean, and we keep making the point that we're coming off of 2 back-to-back years of 20% plus gains. So we've come a really, really far way in a pretty short amount of time. And with that being said, Larry, that we need to digest a little bit, is this the trade that we should get used to between now and the end of the year? Matt and I have been searching for something to talk about during these market checks, and it's just quiet out there.
It is quiet. And you bring up a good point, right? We've had 2 years of this bull market. Actually, in the third year of a bull market, you do tend to get much more muted performance. On average, it's usually around, 2-3%. So I think more volatility is likely to occur. I think a lot of optimism has been baked into, the Trump trade and what's going to happen. A lot of optimism, both from businesses and even consumers now. And I think that could set up for some disappointments next year. And you could see a lot more volatility as we go into 2025.
I'm looking at your notes, Larry, and I see you lay out the 4 drivers for growth. Clearly, the U.S. consumer, always there, never count out the U.S. consumer. And you've got spending by AI, spending on AI by businesses. We've been talking about that a lot. Moody's says it'll be $2 trillion in infrastructure spending in the next 5 years. A bump in confidence following the election. We've seen that for sure, and I have to imagine it's priced in. Then you have government fiscal stimulus, which has been a huge driver since COVID, right? I mean, in both the Trump 1.0 and Biden administrations, they were just dumping money out of helicopters. But that can't continue if Scott Bessent wants to cut budget deficits down to 3%. So how do we go forward without that fourth leg of the stool?
Well, I still think we have that weapon in our pocket, right? Because if you look at what's already been allocated, whether it's been through the Inflation Reduction Act, the CHIPS Act, the Bipartisan Infrastructure Act, if you think about it, only 25% of that money has yet has only been spent. So that means 75% of that money is still left there in the pipeline to be spent over the next year or so. And I think in an economy that could be more challenged next year, we're going to see a modest slowdown from where we were this year. Why not continue to spend it? Because a lot of that money does still go to red states and in things that will continue to support this economy. So I do think that fiscal spending will be a tailwind as we go into next year.
And so it's interesting. I mean, you lay out the 4 drivers of continued growth, and I wonder how you marry together that focus on those drivers, including fiscal stimulus, with your Fed expectations as well. We were having a great conversation with Gabriela Santos from JP Morgan Asset Management next week, and she said basically focus on the fiscal. Don't lose the forest for the trees here, rather than monetary policy. Where do you fall on that debate?
So when it comes to the Fed, I've said this before, maybe on your show, we think that they'll cut in December. And then for next year, for me, I don't care if they cut 1 time, 2 times, 4 times, or 8 times. I think that's the wrong way to look at what the Fed is doing. I think you have to look at the outcome of what the Fed's trying to do. And if they're able to nail this soft landing and continuation of the expansion, that's the more important question. Because when you look at financial markets, if you get a soft landing expansion, it's a totally different type of environment if you go into a recession. And we still lean into camp that the Fed will do enough to ensure that we prolong this expansion. And that's obviously a positive for earnings growth longer term.
Larry, when you look at, other markets outside of the U.S., they haven't fared nearly as well. They don't have an NVIDIA, I should say, not an Intel. Do you think that some of them have to catch up, or other asset classes besides stocks? Because we've really got back to Tina here in terms of assets and, regions.
Well, we continue to focus on the U.S. Yes, the U.S. has outperformed in 8 out of the last 10 years, but I still think the fundamentals support the U.S. markets. First of all, when you look at next year, economic growth is going to be far superior here in the U.S. We think it's going to grow. The economy is going to grow 2.4%. When you look at Europe and Japan and those areas of the world, it's probably got a 1 handle on it. When you look at earnings growth, we think you're going to be in a double-digit space over in Europe and Japan. It's probably going to be half of that. And then when I look at the sectors that you invest in here in the U.S., you're going to get more exposure to technology, healthcare, industrials, the sectors that we continue to see have the best growth prospects going forward. So that's why I continue to favor the U.S. And then when I just look at the internals, companies are managed better here in the United States. Whether you want to look at return on equity, whether you want to look at how they pay out dividends, buybacks, they're just much better managed here, and that's where we want to keep our focus.
That's a really interesting point, because one of the big trends this year has been a lot of C-suite turnover. We think about Pat Gelsinger over at Intel, just one of the latest examples. Stellantis too, also saying goodbye to their CEO. I mean, how much focus do you need to pay on management in this cycle relative to maybe other cycles?
Well, I think it's important, but hopefully these companies have set up a pretty good bench. And I think a lot of these things is what Wall Street's looking for, right? So you can't come in and then all of a sudden, stop your buyback program or, cut your dividends, et cetera. So I think that these things are done well in advance. In fact, we've had a transition here at our own firm, and it's been done well in advance so that the transition will ultimately be smooth over time. So I think a lot is baked into that already.
All right, Larry, it's always great to speak with you. Have a great holiday season when you get there. That is Larry Adam of Raymond James. Meanwhile, let's get a look under the hood at the stocks moving this hour. We'll do that with Abigail Doolittle.
Well, one of today's big stock stories is Oracle shares are moving sharply to the downside, down about 8%. This after they missed the top and bottom line estimates ever so slightly. But the growth outlook for the current quarter for sales, 8% growth on a year-over-year basis versus 9% in the last quarter. So sequentially, just going slightly in the wrong direction. Cloud growth about flat, and investors cooling off to the stock, a stock that was priced to perfection, high bar expectations, up 80% into the quarter that was reported. So some chips coming off the table. Alaska Air, on the other hand, these shares are trading higher right now, up a very healthy 15%. They have laid out a plan to dramatically expand. The CEO actually revealed in a Bloomberg interview, and will be providing further detail in an investor meeting, that they are planning on on broadening out from that narrow West Coast strip that they have served to Asia initially from Seattle. And over the next 5 years, they could plan out as many as 12 international routes. There is a 7% bearish short interest on this stock, so some of those bears probably want out. And this is one of the better performing stocks on the year, right now up about 58%. And then finally, American Airlines also higher. Bernstein upgrading shares to an outperform, saying that there's a positive overall industry backdrop. In addition, their branded deal with Citi is a positive. And then they believe that American Airlines over the next few years has the ability, Matt, to generate sizable cash flow. Investors seem to like that, up about 5%.
Yeah, although it's been a rough ride for American Airlines investors thus far. Coming up, President-elect Trump's cabinet is at the mercy of a handful of Republicans. We're going to give you more on that uphill battle for Pete Hegseth as well as Tulsi Gabbard next. This is Bloomberg. Let's get now to high interest and look at what's making headlines around the world. Over the past 2 years, Taylor Swift gave out $197 million in bonuses to dancers, truck drivers, caterers, and everyone else working on her Eras tour. Over 10 million people attended those concerts, bringing in over $2 billion through ticket sales. That's double the gross ticket sales of any other concert tour in history, according to Swift's production company. So that's pretty awesome. Small businesses in the U.S. are the most optimistic they've been in over 3 years. And the reason is that man right there, Donald Trump. The president-elect's low tax, low regulation, and America First agenda is boosting hopes that his policies will provide relief from inflation and favor stronger economic growth, although 28% of those businesses plan to raise prices in the next 3 months, according to the National Federation of Independent Businesses survey. And a wildfire in Malibu, California is tripling in size this morning, spurring evacuation orders, forcing schools to shut down and closing a portion of the Pacific Coast Highway. This is a live shot of the fire, which has now spread over 1,800 acres and forced 6,000 evacuations. All Malibu schools are closed until further notice, while Pepperdine University canceled classes and issued a shelter-in-place order. And finally, Trump's pick for Defense Secretary Pete Hegseth plans to keep fighting for the job. Hegseth appeared on Fox News, where he works, and said Trump urged him to persist. Hegseth met with Senator Joni Ernst, a key figure in his confirmation process, and plans to meet with other senators to bolster his support. Let's get the latest on Hegseth's nomination with Bloomberg's Mike Shepard in Washington. And Mike, this is fascinating, especially the support that he seemingly got from Joni Ernst, who's very sensitive to issues of sexual predators and women in the military, yet she seems to be behind him. What's going on?
Well, you know, it's interesting. Her comment yesterday indicated support for Hegseth through the nomination process, and that included the open public hearing that we eventually expect him to get. She did, however, stop short of endorsing him outright and promising a yes vote. And that is exactly what he will need to be able to get this job in the end. And it right now looks like he is still short of the slam dunk yes votes that he would need to be able to breathe easier and maybe dial back the lobbying campaign that he has been waging on Capitol Hill. It's very much caught the president-elect's notice, and he seems to appreciate his selection's efforts on the Hill to try to win support. But he does have an uphill climb. The allegations of sexual misconduct, alcohol use, and mismanagement at a veterans group are hanging over his selection. He's denied all those claims, of course, but nonetheless, it is making it harder for Ernst and other senators to automatically be a yes, the way they might be for somebody like Scott Bessent at Treasury.
The problem is allegations of alcohol abuse, right? Not just use. The allegations are that he drinks way too much at professional events. and then behaves accordingly. Although I think President Trump has said he's been assured it's not a problem.
Yes, but of course, like Michael is saying, still an uphill climb for Hegseth. Controversial pick there. Another controversial potential here is, of course, Tulsi Gabbard, especially when it comes to some of her past views on Syria. What is the latest there?
Well, I'm glad you brought up Gabbard, Katie, because this is a nomination that has been a little bit off the radar screen thanks to all the attention that has gone to Pete Hegseth's nomination process and battle unfolding now on Capitol Hill. Gabbard raises some concerns among even some lawmakers, Republican lawmakers, over those comments about Russia and about Syria. Her comments on Russia suggests a more favorable view by her toward Russia and toward Vladimir Putin. She was even heard echoing some Kremlin talking points about the war in Ukraine, including about some false claims that the U.S. had funded bioweapons research labs inside the country before the war. So that is something that has caught the attention of lawmakers who would have to vote on her confirmation. And remember, she is up for a very sensitive job. The Director of National Intelligence oversees roughly 18 spy agencies and has access to some of the nation's most closely guarded secrets. And it's really critical to have somebody that has the nation's complete trust and is someone who would put the U.S. first, maybe ahead of other adversaries such as the U.S. and even Syria in this case.
Yeah, Russia and Iran may be problematic there. Shep, I wonder about what this kind of uphill battle for so many nominees already, right? We've had Matt Gaetz pull out. Sheriff Chad is not going to run the DEA. Concerns about Hegseth and Gabbard. We're not even in the next Congress yet, right? So what does this say about Trump's plans to extend the TCJA, to get rid of the SALT deduction cap, to cut regulations, if he's already facing these pressures on cabinet nominees?
Well, with the pressure on the cabinet nominees, the Senate is trying to send a signal that, look, we're not just going to roll over on everything. And let's be clear here that some of these nominees, with them, Trump is very much testing the waters and really pushing the envelope. And he knows it. And he came to voters on the campaign trail promising big changes, including by taking on the way the Pentagon and, yes, the intelligence and law enforcement agencies here in Washington operated. And that included by promising to put in some controversial nominees there. But it's important to separate some of the economic plans and policies that he has in mind there, too. Those may get a more favorable reception in Congress, especially with Republicans who really do want to stick with those bread and butter issues of tax cuts, of trying to build up and protect the economy by reducing what they see as an unfair regulatory burden. So we have to look at it as sort of a warning shot on one level, but when it comes to those questions about the economy, I think that those will get a separate hearing. It won't be any less thorough, but it may be a little bit more receptive and less skeptical.
All right, Mike, always appreciate your reporting. Of course, it's going to be fascinating to cover these confirmations, and you'll be all over that. That is Michael Shepard joining us from Washington. Now, still ahead, it may be the end of an era for Taylor Swift, but the live entertainment industry poised for another banner year in 2025. Details next. This is Bloomberg. All right, it's time now for Social Climbers. The company's making waves this morning. And first up, the parent company of DSW Footwear cutting its full-year guidance as inflation-weary consumers curb their spending. Designer Brands also said that warmer than usual weather hurt sales of its winter offerings. It's the fourth straight profit miss for the company, which has been trying to offset the weakness with a sharper focus on athleisure offerings, not quite bearing fruit yet. Down about 6%, but we had been down by more than 20% pre-market, so some of those losses coming back. Next up, Alphabet's Google is showing off a new quantum computing chip that could bring practical quantum computing closer to reality. The custom chip called Willow does in minutes what it would take a classical computer 10 septillion years to complete. That is a lot of numbers there. In other words, it's a time frame that's longer than the age of the universe itself. Great perspective. Finally, live entertainment is thriving, and 2025 set to be a banner year. Industry leaders like Live Nation are seeing significant growth, and Coldplay, for example, sold out 90,000 seats at London's Wembley Stadium for 10 dates next summer. And Matt, this is for you. Dead & Company is set to return to the Sphere in Las Vegas this spring for an 18-show residency. Just an embarrassment of riches here when it comes to live concerts.
Absolutely. I am looking for tickets to the Sphere, so if anybody out there wants to take me, I'm happy to join you.
That's a very good use of your platform.
Yeah, Coldplay, you know, I've seen them, but it's shocking that they sold 900,000 tickets at Wembley.
That is crazy. I mean, Coldplay, it's like the definition of easy listening, so that's a wide addressable market, but even still, just bananas there. A lot of people excited to see Coldplay, specifically in London. But before we get there to that tour, let's take a quick check on markets right now. Of course, we are about an hour into the trading day. Not a lot of action, but you are seeing a rebound in NVIDIA shares that's helping to lift the S&P 500, helping to lift, in particular, the NASDAQ 100 up about 0.5%. And again, not much movement in the bond market, but a little bit of a sell-off. We'll discuss it all up next with Barry Knapp. He is Director of Research over at Ironsides Macroeconomics. That conversation up next. Don't go anywhere. This is Bloomberg.
All right, we are looking at some fairly muted moves in stocks as investors await tomorrow's inflation report. Let's get a check on what's going on in the markets in terms of the individual movers. For that, we go to Abigail Doolittle. Abby?
Well, Matt, let's start off with that S&P 500, because while it may be up slightly today on the week, we may be looking at something. The week, yes, is very young. It's something we haven't seen in some time, and that is a down week. Right now, down about 0.5%. Again, the week is very, very young. The bigger point is week after, yes, it's Tuesday, week after week, though. But this is, to the point, though, this is the worst 2 days for the S&P 500 going back by about 3 weeks, because that's how many gains we've had. Out of the election, the S&P 500 up more than 6 or 7%. Some investors and strategists saying that the complacency is nerve-wracking to them. In fact, Chris Murphy of Susquehanna told that to me on Options Insight last week. We also have Scott Bauer of Prosper Trading Academy saying the same thing, who pointed out, actually it was Steve Sosnick of Interactive Broker, who pointed out that the skew index, if we go into the Bloomberg terminal, this is not the VIX. It is the quote-unquote panic index, far out of the money puts. It actually recently hit a record high, and it's been pretty predictive recently, not in terms of an initial a moment-by-moment trade to the downside. But after the skew index spikes, a month to 2 months later, we've seen pretty big sell-offs, including back in 2020. We had the decline into it in 2019, ahead of 2022, and some of the smaller sell-offs. So this could be something to pay attention to think that this year's robust rally of 29% for the S&P 500, well, maybe there's going to be a cooling off. But
that's right now, chart. It goes back, what, 2 decades?
It goes all the way back, yes, 2 decades to about 2001. And traders actually for a long time did not like the skew index because it is so far to the money. But I would say that it's worth noting because of ahead of the 2015 sell-off, ahead of 2018, and then really ahead of that pandemic sell-off, you had the skew index rising about a month ahead of time. And there's a few other spots as well. But right now, the bulls are in charge. Again, the S&P 500 almost up 30% on the year. Today, we're looking at Alaska Air up 16% on their expansion plan. They're talking about as many as 12 routes over the next 5 years on an international basis, getting out of that narrow West Coast strip. Alphabet up 4%. A lot of enthusiasm around their Willow quantum chip. To the downside, though, MongoDB down 10.5%. They put up a great quarter and boosted. However, the CFO is leaving Guggenheim, saying that is not a positive. And then, Katie, finally, C3 AI down about 4% at this point. They did put up a massive beat, but CEO Tom Siebel has put out a notice saying that he may sell shares. Well, investors just a little bit nervous, but this stock, it should be noted, well off the lows.
Yeah, and a nice reminder, too, that we're still in earnings season, and it does matter. Abigail Doolittle, thank you so much. Joining us now, I am pleased to say, is Barry Knapp. He is Director of Research and Chief Market Strategist over at Ironsides Macroeconomics. He is in studio. It is great to see you in person.
Nice to be here.
So the week is young, but the year is old. It's almost 2025. So let's just talk about the year ahead, because you have all these different cross currents between the economy, the Fed, and then, of course, politics and what's going on with the fiscal situation. What keeps you up at night? What would you say is the biggest risk when you look at the year ahead?
Oh, it's the debt sustainability issue, the implications of running 7% deficits on, I guess there is this constant statement, even when Jerome Powell gets asked about this, to say our current level of debt is sustainable, but it's on an unsustainable path. For me, the real issue there is it creates an inflationary impulse, and then the second order effect is it's a negative for productivity to have government spending running at 24% of GDP rather than its 50-year average of more like 20% of GDP. Had Harris been elected, there was a very low probability that we would have gone off that 24% trajectory. And just to provide a little bit of perspective, government spending, as I mentioned, has averaged 20% of GDP since 1980. My view on this was there was a tacit agreement between the two parties that if there was a recession, they could elevate it to 23, 24%, but then they were supposed to take it back down to 20 once the recession was over. We've been at 24 for 3 years. The CBO projects it to stay at 24. This is the key issue. And a big element of the supposed Trump trade was this idea that the back end of the bond market was going to really sell off hard. So if I thought about the first part of the year and whether the greater risk was another growth scare like we had in August, where we truly get worried about earnings. We could talk about that divergence between earnings and revisions and stock prices right now, which is pretty big. But the risk of a growth scare versus the risk of a disorderly sell-off in the bond market, say 10-year yields going back to 4 3/4 or 5, I think that latter risk is much higher. And it really does depend on the sequencing of policy, tax versus trade policy, spending cuts, and how they're integrated into the making Tax Cuts and Jobs Act tax rates permanent. That whole policy, you know, all those steps are pretty risky.
But Barry, if you step back and look at, I mean, spending cuts, everybody wants to cut spending. Everybody thinks that government spending is out of control, right? Everybody wants to reduce the deficit. What is it, $36 trillion
Something like that
right now?
Is the debt.
But I don't understand the total debt. I don't understand how Scott Bessent plans to take the deficit down to 3%, how Donald Trump plans to have Elon Musk and Vivek Ramaswamy cut government spending by $2 trillion and still grow the economy by 3%. I mean, how can you remove that much fiscal stimulus, effectively put on such a huge fiscal break, and still grow the economy?
Yeah, so my view is that the probability of growth accelerating next year, or even Bessent hitting the second of his third arrows next year, is reasonably low. It's unlikely to accelerate. It may actually contract, as you said, but the mix matters, right? The mix matters a lot. We had an 80 basis point contribution from government spending last quarter. That is not a positive for our long-term productivity outlook.
True.
So,
but I still don't understand. These policies look like they're going to increase inflation and stunt growth.
Right. But if you look at what's gone on with capital spending, so spending on software even, which has been just straight up to the right for decades, software spending has decelerated decidedly. So has equipment spending. So has infrastructure or structures, physical plant. There's a big business confidence boost that's taken place as a consequence of the election. And if you look at things like the regional Fed surveys, both services and manufacturing, the 6-month forward cap spending plans are quite strong right now. So you need that tax certainty, regulatory policy, and then you start realizing it, and then you get an 80 basis point or 100 basis point contribution from capital spending that replaces the government spending. Now, again, it may not be one for one, but if you think about the outlook for corporate earnings, capital spending, strong capital spending, is far better for corporate earnings than government spending, other than a few isolated sectors. So if let's say we keep consumption relatively constant, we reduce government spending, but you get private sector capital spending to accelerate, even if the total growth rate is even a little lower than it is now.
It's a better mix.
It's a better mix for S&P 500 companies, for small cap companies, for the corporate sector.
For our society.
For long-term productivity growth, for all that
Yeah. And a lot of the points that you're bringing up, we saw that in the NFIB numbers this morning with the Small Business Optimism Index and the forward plans, too, to create new jobs and also raise prices. But I want to talk about how you invest around this. To bring it back to debt sustainability or unsustainability, when does that actually show up in the bond market? We got blushes of it earlier this year, especially after the re-election, 10-year Treasury yields knocking on the door of 4.5% once again, but that was pretty short-lived.
Well, we've had 3 significant episodes that have indicated we're approaching our fiscal limit. The first one was from January 4th, 2021, the day the Republicans lost the Senate in Georgia, through the signing of the American Rescue Plan. You had 30-year real rates, TIPS yields, go up 60 basis points on a straight line. That's the part of the curve least impacted by the Fed's balance sheet or rate policy. Straight up. But then Janet Yellen, who had $1.7 trillion in her checking account, the Treasury General account, decided, I'm just not going to issue for the next 8 months. So the market rallied. And of course, the Fed was still buying $1.5 trillion of treasuries and mortgage-backed securities. So that was episode number 1. Policy got it back under control, but it's a Band-Aid to do it that way, right? The second episode was in the third quarter of 2023, when 10s went to 5%, after Yellen announced, I have an extra $500 billion in notes and bonds for sale in the second half of the year. Again, that was interrupted by increasing the amount of bills that they issued and the Fed pivoting. So again, policy stopped it in its track. Same thing's going on today. The market was pushing higher, Treasury market rates, that is. And we came to the election. When the week that Basak was nominated, we had a 20 basis point move across the curve. 10 and 30-year swap spreads tightened. Right? Something Michael Collins, I think, has talked to Sonali about. You know, it's an indicator of supply. So the market's pretty confident that they're going to get at this, using spending cuts to fund the tax cuts and getting the debt sustainable. Part of that for me is he needs to extend issuance. The Fed needs to continue QT longer. Now, both those things would actually push rates higher. But if you do that combined with taking the policy rate down to 3.25%, which is my forecast for next year.
That's pretty interesting. You think the Fed's going down to 3.25% terminal rate?
I do, because what they will then be doing is more evenly distributing policy across the capitalization spectrum, if you will. Right now, the small business sector is bearing the entire burden of the tightening. Because of raising short rates up so much, you've deeply inverted the curve, hurt small banks. The cost of capital in that NFIB survey has come down, but it's still prohibitive compared to investment grade companies. And so that's why small business employment is as weak as it is. And the small business, Russell's underperformed. The whole small business sector has suffered with the way the Fed conducted policy, which was totally wrong.
Well, and by the way, if the Fed brings the rate down to 3.25%, which is like 75 basis points lower than the market thinks, it's going to make this chart. It's going to make this chart a whole lot more palatable, right? Because right now, this is costing us over $1 trillion a year in interest costs. Barry, right. I wish we could have you for an hour. It's great getting some intel from you. Thanks so much for joining us. Barry Knapp there of Ironsides Macroeconomics. Tomorrow on Bloomberg, David Gura is going to sit down with Treasury Secretary Janet Yellen. Barry's going to send him some questions right now. We've got an exclusive interview ahead of her departure from Treasury. We'll bring you that conversation live at 10:30 a.m. Eastern. And I am definitely pumped.
I am psyched. That is going to be a great conversation.
There'll be great questions.
Yes.
It'll be interesting to see what kind of
answers are produced from
we get
questions.
From Janet Yellen. 10:30 tomorrow. Don't miss it. This is Bloomberg.
All right, it's time for our daily Wall Street Week conversation. And the number of Americans over the age of 80 is expected to grow rapidly in the next 25 years. David Weston spoke with Merrill Gardens President Tana Gal about the supply and demand for high-quality senior living.
We have been fortunate enough to watch our industry go through two very big cycles where we, as I mentioned back in the mid-90s, when assisted living hit Wall Street, nobody was public before, but a bunch of companies went public in the mid to late 90s. And they built a lot of assisted living. And then we had the dot-com bust and things slowed down again. And what was good from that is it took all those buildings that we built and filled them up. And so then the supply demand was in a nice balance for quite a few years. And then when the recession hit in 08 to 10, same thing happened. We had a lot of product on the market and people weren't moving in. I think an interesting statistic is about 85% of the people that move into our communities will have sold a home before they move in. So during the recession, when people couldn't sell their homes, we weren't seeing as many move-ins. Again, we were able to get through that recession and there was some built up demand. And so we were able to kind of level that out again. So now as we come into a new economic climate, it is probably the lowest I've seen on construction starts, maybe in my 30 years. So in some ways that's a little bit distressing to me, but what I'm seeing happen is everybody's filling up. Our occupancies, I'd say, as an industry are back up to about where they were before the pandemic. And so even though there's some slow starts in construction, we will be able to kind of look for sites to build and be ready to go when the capital markets turn a bit that are more favorable.
What do you regard as full occupancy for your properties, and are you there now?
Yeah, so we like to think stabilized occupancy is about 95%. We do as a company. I know other companies look at it about 92, 93%. And so I feel very fortunate right now that if I didn't have a couple communities that just opened, we would be at about 92%. But I just opened a building in Portland, Oregon. And so it took it down just a smidge because we're filling it up. So we look at stabilized occupancy, let's say between 93 and 95%.
Is it a good business? I assume it must be, or you wouldn't be in it. But what makes it a good business?
You know, when I jumped into senior living, I didn't think I would be in it for very long, to be honest. I thought, oh, I'll give this a try, see what it's about. Everybody told me, you know, the people are really nice in the industry, and I thought it would be like a 6-month gig. And I literally woke up in August, and I've been doing it for 30 years. And here's why I love it. It matters. I get to make a difference in people's lives every day. And it's pretty significant. So for me, it's like working with the team members. If I treat my team members great, I know they treat my residents great.
And that was the president of Merrill Gardens speaking with David Wesson. You can catch Wall Street Week every Friday at 6 p.m. Eastern. This is Bloomberg. Well, this year's record rush into ETFs not slowing down, with investors plowing over $1 trillion into the industry. Assets held by ETFs in the U.S. specifically now total over $10 trillion. Joining us now with more is Bloomberg cross-asset reporter Isabel Lee. So the flows are interesting by themselves, but I actually want to talk about the pace of product launches, because it feels like year after year we have just seen a record-setting pace of new ETFs actually coming and listing in the market.
It's definitely a banner year for ETFs when it comes to flows, assets, and even launches. I think we have around 659 based on Bloomberg's tally. And the asset class is widespread. Of course, this year we saw crypto ETFs. We have Bitcoin, Ether, Solana, and XRP are still in filing. We don't know yet if they will be approved, but that complex is really growing. We have around 120 billion in just 1 year compared to the commodity space, which has a 160 billion in a span of 20 years. And also we have alternative assets. You've covered a lot about the credit, private credit filings of those. So if that comes through, it'll be even a breakthrough next year, and maybe we'll see even a bigger year.
So my mom texted me yesterday in this block, and she was like, I don't really get ETFs, you know?
She doesn't watch ETF IQ?
Well, I'm going to recommend that she start to watch that show. She stopped watching after I was removed as co-anchor.
Sense.
But you can't really be playing with these in your 401k yet, right?
No, and that's, I think, the last holdout. But other than that, ETFs are one of the best wrappers. It's easy to trade. You see a lot of conversions. We're also seeing record launches when it comes to count and assets. We have mutual funds converting into ETFs, even BlackRock converted. and even SMAs. So everyone is just really piling on.
I mean, I said this. I said it's easier to trade than, you know,
They're
mutual
lower
funds
cost
and lower cost.
intraday.
By the way, are they always lower cost than mutual funds? Because it must, especially an active ETF, must take the same kind of management fees in terms of paying your people, right? So
the costs have been coming down. It's like a race to the bottom. And broadly speaking, they are lower cost than mutual funds. Just quickly on the 401ks, if I can. That is the final frontier, it feels like. We talk about that chart all the time. Inflows into ETFs, outflows from mutual funds. They do have that incumbency advantage. So there are some holdouts. And with all these launches, we do see a lot of closures, too. It's not all rosy.
It's not all rosy, but it's not a record year for closures. We saw actually more closures last year. And when I asked Bloomberg Intelligence Atanasio Sarafagis, I was like, why aren't we seeing record closures this year? And he said, bull market, baby. So a huge reason also, and we can't discount that, it's the bull market. I mean, people are happy, they're exuberant. That's why they pile into these ETFs. So there are really a lot of external factors. But next year's exciting.
are there some hot launches coming up? Because I remember back when we did this together.
Right, the ETF show.
Like Nance and Cruise, are those still?
No, I don't think, I think at least one of them shut and it was difficult.
Because I love the idea of using an ETF to track the trading of members of Congress. The problem is they don't disclose enough to make it easy.
That's fair.
Well, I think that's a great point because ETFs are becoming more and more active. Those active launches are huge.
Active launches, most of the launches we've seen this year are active launches. But active is tricky because it's not really super active. A lot of the things we're seeing this year are single leverage stocks. Tesla, MicroStrategy, even Warren Buffett's Berkshire Hathaway is seeing a single stock leverage. I don't know how that will play out, but retail investors love
3x Berkshire Hathaway B shares?
Just 2x.
Just 2.
Yeah.
Okay, you got to be conservative when you're talking about Warren Buffett.
It's funny because, you know, you think about the single stock launches that have been really successful. It's like Nvidia, it's Tesla, which are very volatile stocks.
MicroStrategy.
Berkshire Hathaway isn't exactly a very volatile stock.
But I think it's because his shares are expensive, and retail traders just love him. It's Class B, so not Class A. I would be so impressed if I meet someone with Class A.
Not the most
Many
expensive.
of our readers probably have that.
Yeah.
Viewers.
We have viewers on TV.
Viewers.
You have readers at BN. We have viewers here.
That's true. Isabel Lee, great roundup, of course. A record-breaking year in the ETF industry across multiple measures there. You can
I've been over, by the way, to her desk, and she keeps ETF Go up on one screen so she can always follow the flows.
Isabel's desk is also my desk since we sit right next to each other, so we get a lot of Matt Miller time. In any case, ETF IQ, so it's a show that Matt used to anchor, but I anchor it too every Monday at 12 p.m. Eastern. I also have a newsletter. You can subscribe to it.
Right. That was yesterday's noon show.
Yeah.
Do you know what today's noon show is going to be?
Crypto.
Crypto.
Another show that you used to anchor.
Bloomberg Crypto. I used to, and I'm going to today.
Yeah.
I'm going to come back because Sonali's in London. So I'm going to join Tim Stenivek on set at 12 noon. If you're going to keep watching, you know, Bloomberg Tech is up next with Carolyn Hyde, and it's a fantastic program. But if you do want to take a break, please come back in an hour at noon for Bloomberg Crypto to see me and Tim Stenivek talk about the amazing run of Bitcoin. This is Bloomberg.